TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
Hello, TSS traders. We prepared a summary of the past week for you. And honestly, we're going to need to bring our absolute A game to unpack this one.
Yeah, you can say that again. It was quite a week.
Right. I mean, imagine looking at a financial x-ray where the market just appears to be completely bleeding out. You're staring at the screens, and oil is surging toward like $120 a barrel.
Mm-hmm.
A major conflict is escalating in the Middle East. The news networks are just flashing red everywhere, warning of this, imminent catastrophic collapse in equities.
And everyone is panicking, or at least the headlines are panicking.
Exactly. But then beneath the surface, if you actually look at the plumbing, the smartest money in the room is quietly, methodically building this massive mathematical trampoline to bounce the S&P 500 higher.
Yeah, it's the ultimate disconnect, right, between the headline narrative that everyone is reading on their phones and the mechanical reality of what is actually being traded on the floor.
Totally. They aren't panicking at all. They are just adjusting the valves. So today we are diving deep into that wild, volatile trading week of March 9th through March 13th, 2026.
A week that honestly felt like an entire year crammed into 5 trading sessions.
Seriously. And our mission for you, the listener, is a cut through all that deafening headline noise. We are setting aside the talking heads arguing about Iran and oil futures.
Right, we're ignoring the noise.
Yeah, we're looking purely at the mechanics. And to do this, we are relying on a massive stack of highly detailed AM and PM notes from SpotGamma.
Which are, frankly, the gold standard for this stuff.
Oh, absolutely. They track the hidden architecture of the market, everything from daily options flows and structural gamma levels to the ripple effects of these massive geopolitical tensions.
Yeah, and SpotGamma's notes are essential here because they map out the dealer positioning. I mean, they show us exactly where the market makers are forced to buy and sell.
Right, regardless of what they personally think about world events.
Exactly. It's the difference between guessing what the market should do and calculating what the market mathematically must do based on structural leverage.
And just to be completely clear for everyone listening right at the top, when we bring up things like President Trump's comments or the specific geopolitical conflict in Iran, we are strictly looking at these as pure data inputs.
Mm-hmm. Just variables in a model.
Right. We aren't taking any political stance here. We aren't endorsing any viewpoints. We are just impartially reporting how algorithms, systematic flows, and options dealers reacted to those specific headlines to move the market.
That is such a crucial parameter to set because to a market-making algorithm, a presidential statement or a geopolitical escalation is, it's simply a volatility input.
It just changes the math.
Right. It changes the probability distribution of future price movements. Our job here is just to analyze how that probability shift was priced and traded by the institutions.
Okay, well, let's unpack this, starting with the illusion of panic and the reality of volatility pricing on Monday, because Monday was an absolute shockwave.
Oh, it was wild.
Over the weekend, we saw a severe escalation in the Iran conflict. That sent WTI crude oil soaring overnight, pushing aggressively toward that $120 a barrel mark.
Yeah.
And naturally, equity futures just fell off a cliff in response.
Right. And that knee-jerk reaction is entirely understandable from a macro perspective. I mean, when oil flirts with $120, it threatens to unleash this massive wave of secondary effects.
Like inflation.
Exactly. High oil prices bleed directly into higher inflation, which then forces the Federal Reserve's hand on interest rates, and that ultimately terrifies the equity market.
But then we get to the actual trading session, and we see this massive intraday reversal. By Monday afternoon, following comments from President Trump indicating that the war might actually be nearing an end, oil reversed hard.
Just completely rolled over.
Right. It dropped all the way back down to $85. And the SPX, the S&P 500, which had been bleeding so heavily overnight, completely reversed course. It actually closed up 0.83% for the day.
It was a violent whiplash, just brutal. But what makes Monday so fascinating isn't just that price reversal. It is what happened in the volatility space.
Right. This is where we really have to look at the X-ray closely. The SpotGamma AM note highlighted a glaring anomaly, a critical data point that pretty much defined the rest of the week.
The VIX spread.
Exactly. The VIX, the volatility index, often called the fear gauge, spiked to 32. But the one-month realized volatility for the SPX was sitting at roughly 13.6%.
And that spread is the whole story. I mean,
Yeah.
you have an 18.4-point difference between implied volatility and realized volatility.
Which is huge, right?
Oh, it's massive. That is the widest spread we have seen since the COVID-19 crash in early 2020.
Wow. Okay, let's pause and break down those two terms for the listener, because really understanding the difference between implied and realized volatility is the key to this entire deep dive.
Yeah, it's foundational.
So realized volatility is essentially the actual historical day-to-day movement of the market, correct?
Okay.
It's looking in the rearview mirror at what the SPX actually did over the last 30 days.
That is a perfectly accurate summary, yeah. Realized volatility is just the mathematical measurement of the actual price variance that has already occurred. It is a known fact.
Okay.
If the market is moving 1% up one day and 1% down the next, the realized volatility captures that actual physical movement.
So if realized volatility is sitting at a relatively calm 13.6%, it means the market hasn't actually been swinging that wildly in physical reality.
Right. The actual turbulence has been fairly normal.
But then you have implied volatility represented by the VIX spiking to 32. And implied volatility is forward-looking. It's what the options market expects the market to do over the next 30 days based on the price of options right now.
You are hitting on the exact core mechanism there. When traders aggressively bid up the price of put options to protect their portfolios, that drives up implied volatility.
Because they're willing to pay more for that insurance.
Exactly. It is a measurement of the fear, or the expected variance, being actively priced into the derivatives market by participants willing to pay a heavy premium for protection.
So to use an analogy, this 18.4-point spread is like paying the absolute maximum premium for Category 5 hurricane insurance when it's just lightly drizzling outside your window.
That's a great way to put it.
The realized weather is calm, but the implied weather forecast is just catastrophic. You are paying an absolute fortune for protection against a storm that hasn't even made landfall yet. So why was this spread so aggressively priced on Monday morning?
Because the market makers and dealers who sell that insurance were demanding a massive, what they call an event-related premium.
Okay.
They were pricing in two very specific overlapping risks: conflict vol and energy vol.
Yeah.
The situation in the Strait of Hormuz created this binary risk event.
Binary meaning it goes one way or the other hard.
Right. If the strait closed, oil would skyrocket and equities would plummet. If it opened, the exact opposite would occur.
So the options market essentially instituted a massive geopolitical tax on anyone trying to hedge their portfolio.
Yes, exactly. If you wanted to buy a put option on Monday morning, the market maker was basically saying, look, I will sell you this protection, but because I have no idea what headline is going to hit the wire in the next 5 minutes, I'm going to charge you an astronomical fee to take this risk off your hands.
And SpotGamma's thesis on Monday morning was super unambiguous about this. They explicitly advised traders not to be heroes. They said, do not try to short this volatility blindly.
Yeah, their exact phrasing in the notes was that RIPs should be sold until the Strait of Hormuz officially reopens.
Because only when those physical oil flows are proven to be stabilized do you get a true signal that the systemic risk is off the table.
Right. Until that physical reality occurs, the premium stays incredibly fat.
And that fat premium is what creates the structural opportunity for the most sophisticated players in the market. Because when implied volatility is trading that far above realized volatility, it creates a massive distortion in options pricing.
Oh, man.
Which logically leads us into the hidden architecture of how the smart money actually traded that massive Monday reversal. Because here's the thing about markets. Whenever you have premiums that are that fat, whenever that Category 5 hurricane insurance is trading at record highs, institutional traders are going to look for highly complex structural ways to exploit it.
They aren't just going to sit on their hands, no.
Right.
They are going to step in and provide liquidity where the panic is highest. But they are going to do it in a mathematically hedged way. And this brings us to one of the most brilliant trades highlighted in the entire week's notes.
Yes. I want to spend some serious time on this. I really want to talk about the Hugh Hendry trade.
Such a fascinating setup.
It really is. This was highlighted by Nomura in the source notes, and it is just a fascinating structural approach to exploiting absolute panic. Let's break down the mechanics for the listener. The notes describe this trade as selling 10 to 15 delta out of the money puts to fund the purchase of multiple 10 to 15 delta calls. Because of how skewed the pricing was on Monday morning, an institution could buy roughly 2.5 SPY calls by selling just one single SPY put.
Yeah. And to really understand why this works, we need to dive into the concept of delta and skew. Let's start with delta.
Please. We throw the word delta around a lot, but let's give the listener a rock-solid mechanical definition of what a 10 to 15 delta option actually represents in this context.
Well, delta has a few different functional meanings, but the easiest way to think about it in this context is as a proxy for probability.
Okay, probability of what?
Probability of expiring in the money. So a 10 delta out of the money put option has roughly a 10% chance of expiring in the money.
Got it.
It is an option that is sitting far below the current spot price of the market. It represents tail risk protection. It's the ultimate disaster insurance policy.
Okay, so a 10 to 15 delta put is far out of the money downside protection. And a 10 to 15 delta call is far out of the money upside speculation. Under normal market conditions, how does the pricing of these two things usually compare?
Under normal conditions, puts are generally a bit more expensive than calls. That's because the market naturally has a long bias and fund managers always need downside protection.
So there's a permanent bid under puts.
Exactly. We call that the natural volatility skew. But on Monday morning, the source notes pointed out that put skew was at the 100th percentile.
The 100th percentile,
Yeah.
meaning it has literally never been more expensive to buy a put relative to a call in the history of the data set.
Precise. Well, yes, that is exactly the mathematical reality. The fear was so intense that institutions were panic buying downside protection regardless of the price.
Price-insensitive buying.
Totally. The demand for those 10 to 15 delta puts was so overwhelming that it drove their premiums to the absolute moon. Meanwhile, no one was buying calls because no one believed the market could possibly go up. So the calls were incredibly cheap.
Okay, so an institutional player looks at this massive distortion. They see the 100th percentile put skew, and they realize they can execute this Hugh Hendry trade.
Right.
They say, I can sell just one of these wildly overpriced disaster puts, collect a massive cash premium from some panicked buyer, and use that exact same cash to buy 2.5 relatively cheap upside calls.
It is brilliantly structured. It's a highly leveraged, delta positive position. They are setting themselves up for a massive payout if the market recovers, and they are funding the entire trade using the fear of the broader market.
Wow.
They aren't even putting up new capital. They are just harvesting the panic premium.
I need to stop you there and push back on this a bit because I am putting myself in the shoes of a risk manager at a major fund.
Okay, let's hear it.
You are telling me that these institutions were shorting naked puts, meaning they are legally obligated to buy the market if it crashes in a market where oil just hit $120 over the weekend and there is an active geopolitical conflict.
Yeah, that's exactly what I'm saying.
That sounds absolutely terrifying. One bad headline out of the Middle East, one missile strike, and that short put blows up your entire portfolio. You are essentially stepping in front of a freight train to pick up a gold coin.
Your assessment of the risk is completely accurate, and the source notes validate that exact fear. They specifically quote Nomura, stating that executing this trade requires a titanium stomach.
The titanium stomach, I love that.
Right, because most traditional institutional risk departments would never sign off on this trade on Monday morning. There was no fundamental edge yet. The geopolitical risks were totally unresolved.
Right.
If the Strait of Hormuz actually closed, those short puts would have caused catastrophic losses.
But the wild part is the data proves somebody actually did it. Multiple somebodies. The institutional plumbing was working exactly as Nomura described.
We see the physical footprint of this trade clearly in the IRO indicator from Monday afternoon.
Okay, let's explain HIRO for the listener, because SpotGamma relies on this heavily throughout their notes. HIRO stands for Hedging Implied Retail and Institutional Options. It's a proprietary data feed, but what is it actually measuring under the hood?
So HIRO is an incredibly powerful tool because it doesn't just look at total options volume. It analyzes the bid-ask spread of every single options trade in real time.
Okay.
By looking at whether a trade was executed at the bid or at the ask, the HIRO algorithm infers whether the customer was buying or selling that option.
So if a massive block of puts is traded on the bid, HIRO assumes a customer is selling those puts to a dealer.
Correct. And once it knows what the customer is doing, it calculates the cumulative delta exposure that those trades are forcing onto the options dealers.
So it's tracking the pressure.
Exactly. HIRO shows us the directional pressure that options flow is putting on the underlying market. It reveals how the market makers are being forced to hedge.
And the footprint left on Monday was gigantic. The notes show that HIRO registered a positive $14 billion S&P 500 net delta flow.
which is just a staggering number. And when SpotGamma broke down the components of that $14 billion flow, it was driven almost perfectly evenly by two things.
What were they?
$7 billion of 0 days to expiration, or 0 DTE, put selling, and $7.7 billion of longer-dated call buying.
There it is. That is the smoking gun of the Hugh Hendry trade. For you listening, this is exactly what we mean when we talk about the mechanics driving the price action rather than the headlines.
It's all right there in the data.
Let's walk through the actual dealer hedging process here, because this is where the magic really happens. A systemic fund sells $7 billion worth of overpriced 0 DTE puts to a dealer. What does the dealer have to do?
Well, the dealer is now long those puts. And being long a put gives the dealer negative delta. It means they make money if the market goes down, but lose money if the market goes up.
And market makers hate directional risk.
Exactly. Market makers do not want directional risk. They want to remain delta neutral and just collect the spread. So to hedge that negative delta, the dealer is forced to immediately go into the futures market and buy the S&P 500.
So selling puts literally creates dealer buying.
Yes. It mechanically forces the dealer to buy equities. And then that same systemic fund takes the cash from those puts and buys $7.7 billion of longer-dated calls from the dealer.
So now the dealer is short those calls.
Right, and being short a call also gives the dealer negative delta. So once again, the dealer is forced into the futures market to buy the S&P 500 to hedge.
Wow. So both legs of this massive structural trade forced the market makers to aggressively buy the underlying index.
They had no choice.
You had extreme headline panic in the morning, which made puts incredibly expensive. Then you had systematic players step in, execute this leveraged trade, and their actions mathematically forced the dealers to buy billions of dollars of equities, squeezing the market violently upward to close green on the day.
It perfectly explains why the index disconnected from the doom and gloom narrative. The sheer volume of the systematic options flows just overwhelmed the fundamental fear of the news cycle. The plumbing dictated the price.
But while the upside on Monday was explosive due to that delta squeeze, the downside was actually being protected by a massive, almost invisible structural floor. Which begs the question, when futures were down so heavily overnight Sunday into Monday, why didn't the market just completely collapse before the Trump comments even happened? Why didn't the floor fall out entirely?
To answer that, we have to transition from looking at delta to looking at the broader gamma landscape.
Okay, let's go ahead.
SpotGamma mapped out the key structural levels for the week. They identified heavy resistance sitting at 6,900. They placed their pivot level at 6,900 as well, but their major structural support was targeted way down at 6,500.
And in between the current spot price and that 6,500 support level, the market was rolling through what the notes refer to as a gamma trough in the 6,600s.
Right, the trough.
We need to dissect this, because a gamma trough sounds like a very dangerous place to be. Let's make sure the listener is with us on mechanics of negative gamma.
This is a foundational concept. Gamma is the rate of change of delta. It tells us how much an option's delta will change when the underlying stock moves by 1 point.
So if delta is the speed of a car, gamma is the acceleration.
That is a perfect analogy. Now, when the broader market drops below certain key levels, usually where there are large concentrations of put options, the options dealers transition from being in a positive gamma state to a negative gamma state.
Okay.
This means the dealers are net short gamma across their massive portfolios.
And what does being short gamma physically require a dealer to do on their trading screens as the market moves?
When dealers are short gamma, their delta exposure moves in the opposite direction of the market. If the market drops, their delta becomes longer, meaning they have too much positive exposure.
So to get back to neutral, they have to sell.
Exactly. They are forced to sell futures. If the market rallies, their delta becomes shorter, and they are forced to buy futures.
So they are mechanically forced to buy high and sell low. They have to trade with the prevailing momentum of the market.
Which is exactly the opposite of what they do in a positive gamma environment. In positive gamma, dealers act as market shock absorbers. They buy the dips and sell the rips, constantly dampening volatility.
But in a negative gamma trough.
In a negative gamma trough, the dealers are essentially pouring gasoline on the fire. Their hedging requirements exacerbate every single market swing.
That makes total sense.
And this is the exact reason why the SpotGamma notes repeatedly warned all week that rallies are likely to be quite unstable. The structural shock absorbers just weren't there in the immediate vicinity of the 6600s.
Right. The local neighborhood was completely devoid of support, but there was a stabilizer lurking below. And this was, for me, the most fascinating specific detail in all of Monday's notes.
Oh, I know what you're going to bring up.
Down in the absolute depths of the options chain, waiting to catch a falling knife, there was a behemoth. I'm talking about the JP Morgan March 31st expiration 6,475 put strike.
The JPM put. It is a legendary structural piece of the modern market.
This single strike was holding roughly 35,000 contracts and possessed massive negative gamma. The notes highlight we are talking about negative 5.9 billion in total gamma.
A staggering position.
Now, earlier I called this a gravitational black hole, but that's the wrong way to look at it, because a black hole destroys everything that gets near it. A much better analogy for what this level represents is a massive, highly tensioned trampoline bed.
The trampoline is the correct visualization, yeah?
If the market falls far enough and fast enough, it eventually gets this massive concentration of institutional positioning. And the historical context provided by the SpotGamma source makes this even more compelling.
Right, they brought up 2025.
Yes. They noted that this exact same JPM structure, albeit at a different strike price of $5,565, was actively in play during the massive market chaos driven by tariffs back in March of 2025.
Yeah, and if you look back at that 2025 data, the market repeatedly attempted to break lower during the tariff panic, but every time it approached that specific JPM put wall, it bounced.
It just couldn't break it.
It bounced multiple times, completely arresting the momentum of the sell-off until the quarterly options expiration finally passed and the position rolled off. SpotGamma's thesis was that this new 6,475 strike would act as a similar structural stabilizer into the second half of March 2026.
Because it's essentially a massive line in the sand drawn by one of the biggest financial institutions in the world. But I want to understand why it acts like a trampoline. Why does hitting a giant put wall make the market bounce up instead of crashing through it?
Well, it comes down to two second-order options Greeks that dictate how options behave as parameters change: Vanna and Charm.
Okay, let's unpack Vanna and Charm for the listener. These are the deeper plumbing mechanics.
Let's start with Vanna. Vanna measures how an option's delta changes when implied volatility changes.
Okay.
When the market is crashing toward this 6,475 strike, volatility is naturally spiking. This spike in volatility actually changes the hedging requirements of the dealers who are short those puts.
How so?
As the market approaches the strike, dealers have to rapidly buy back their short futures hedges to monetize them and stay neutral.
Oh, so that rapid buying of futures by the dealers to monetize their hedges is what creates the physical buying pressure that bounces the market. That's the trampoline physically pushing back up.
Yes, exactly. And then you add Charm into the equation.
What does Charm do?
Charm measures how an option's delta changes simply because time is passing. It's the effect of time decay on delta. As we get closer and closer to that March 31st expiration date, the gamma and delta associated with that massive out-of-the-money put position become intensely concentrated.
So as the clock ticks down, the magnetic pull, the gravity of this specific strike, mathematically grows heavier and stronger.
It exerts a structural force that can literally halt a crash simply because options dealers across the street have to monetize, adjust, and hedge against that one specific gargantuan strike. The mechanics of their hedging overrule the macro panic.
It's incredible to think about. The headlines in the news networks are screaming about war and oil embargoes, but the S&P 500 is actively bouncing off a mathematical trampoline built by JP Morgan's derivatives desk.
It's the reality of modern market structure.
It really is.
Yeah.
So we have this massive floor down at 6,475. We have heavy resistance up at 6,900.
Yeah.
And we have this massive volatility premium acting as a geopolitical tax. As we transition the narrative into Tuesday and Wednesday, the spot price of the market starts bouncing wildly between these levels.
Yeah, Tuesday and Wednesday were defined by a classic, incredibly frustrating whipsaw pattern.
But under the hood, the volatility metrics were sending some very conflicting hidden signals.
It was a trader's nightmare, honestly. On Tuesday, the SPX closed down slightly, 0.21%. But what was happening beneath the surface in the volatility space was highly irregular and deserved close attention.
What was it?
Despite the ongoing headline volatility regarding oil in the Middle East, the VIX actually closed down 2.31% on Tuesday.
Wait, so the market dropped a little bit, but the fear gauge, which usually goes up when the market goes down, actually dropped significantly.
Yes, that is an anomaly. But the bigger anomaly was happening one derivative layer deeper. While the VIX dropped, the VVIX closed up 2.20%.
Okay, we need to clarify VVIX. If the VIX is the implied volatility of the S&P 500, The VVIX is the implied volatility of the VIX itself.
Exactly. Well, you hit the nail on the head. The VVIX measures how fast the VIX itself is expected to move. It is essentially measuring the demand for options on the VIX.
So this divergence is the key to the puzzle. The VIX goes down, meaning general fear is subsiding slightly, but the VVIX goes up, meaning someone is aggressively buying options on the VIX, expecting the fear gauge to suddenly explode.
SpotGamma seized on this specific VVIX divergence in their notes. They referenced a backtest they had previously run on this exact setup, explicitly calling this divergence the institutional tell.
The institutional tell. I love that phrasing. What exactly is it telling us?
When VVIX rises sharply but the VIX stays flat or drops, that divergence strongly signals that highly sophisticated institutional traders are pre-positioning for a massive volatility spike before the spot market actually drops.
Walk me through the logic of that. If I'm an institutional trader, why am I buying VVIX instead of just buying puts on the S&P 500?
Because the puts on the S&P 500 are already historically expensive, as we discussed earlier with that 100th percentile skew. The smart money doesn't want to overpay for direct equity protection.
Right. They are going to buy the overpriced hurricane insurance.
Exactly. Instead, they buy tail protection early by buying call options on the VIX itself. They know the macroeconomic storm is coming, even if the current spot VIX hasn't reacted yet. They are front-running the broader market panic by securing cheap convexity in the volatility derivative space.
They are buying the insurance on the insurance company before the hurricane hits. It's brilliant.
It's extremely smart positioning.
But then we get to Wednesday, and the market behavior gets even weirder. We had the CPI inflation release on Wednesday morning, which is usually a massive catalyst. Oil prices were still rising toward $100. We had this institutional tell warning of an imminent volatility spike.
It's so much tension.
And yet, despite all of these massive macro forces pushing on the market, the S&P 500 stayed relatively range-bound all day between 6,600 and 6,820. How did the market absorb all that geopolitical and inflationary tension and basically just go nowhere?
The answer to that mystery lies in intraday structural trades. Specifically, the notes highlight the presence of massive 0 days to expiration, or 0DTE, iron condors.
Iron condor.
Yeah. SpotGamma noted a 5,000-lot 0DTE iron condor executed on Wednesday, and later in the week, they tracked an even larger 10,000-lot iron condor on Friday.
For the listener who might just buy straight calls or puts and doesn't trade multi-leg strategies, we need to explain how a massive iron condor physically pins the broader market. What are the mechanics of this trade?
An iron condor is a non-directional strategy. It involves selling an out-of-the-money put spread below the current market price and simultaneously selling an out-of-the-money call spread above the current market price, all expiring that exact same day.
So it looks like a bird with wings. You established a lower boundary and an upper boundary. And you collect premium as long as the market stays between those wings.
Correct. When a large institutional player executes a 5,000 or 10,000 lot iron condor, they are flooding the market with short volatility at those specific upper and lower boundaries. They are essentially saying, I bet the market doesn't move past 6,800 on the upside or 6,600 on the downside today.
And who is taking the other side of that massive trade?
The options dealers, the market makers, are forced to take the other side to provide liquidity.
Right, so the dealers are now long the wings of the condor.
Yes. And here is where the mechanical pinning effect occurs. To hedge their long positions on the wings, dealers trade in a way that inherently compresses volatility intraday.
How does that work?
As the spot market starts to rally and moves toward the upper strike of the condor, the dealer's delta changes, and they are forced to sell futures into the rally to stay hedged. As the market drops toward the lower strike, they are forced to buy futures into the sell-off.
They're physically fading every single move. They buy the dips and sell the rips, completely trapping the price action within the boundaries of the condor.
They are actively dampening the price action, essentially pinning the market within that defined range. Unless a macroeconomic shock like a sudden missile strike or a horrific CPI print is violent enough to completely break through the dealer hedging and shatter the wings of that condor, the market gets stuck in the mud.
So these massive condors were acting as synthetic shock absorbers, artificially keeping the market calm despite the terrible inflation data and the soaring oil prices. It's like throwing a heavy blanket over a struggling animal.
That's a good way to look at it.
And because of this macro tension being compressed, the source notes point out that everything across the broader market was starting to move as one giant correlated blob, right?
The notes highlight a very specific metric to quantify this. ERR1M, which is the one-month implied correlation index. The data showed it spiked to 35 during the midweek sessions.
A spike to 35 in implied correlation is a significant jump. What does that actually tell us about the psychology of the market?
It tells us that individual stock fundamentals were being completely thrown out the window. When correlation spikes, it means all the stocks in the index are moving together in unison.
So Apple and Exxon are trading the exact same way.
Exactly. It indicates a highly correlated, macro-driven risk-off event. Traders aren't looking at price-to-earnings ratios or product launches. They are simply looking at their screens, seeing the geopolitical risk, and shifting wholesale from equities as an asset class into bonds, commodities, or cash.
The baby is getting thrown out with the bathwater.
Right.
But here's where it gets really interesting for anyone willing to dig deeper. Because while the broader index was acting like a correlated blob on the surface, if you looked beneath the hood at specific sectors, they were telling completely different, fundamentally contradictory stories.
Oh, absolutely.
This brings us to the sector rebellion.
This is where the divergence between macro hedging and micro fundamentals became starkly apparent in the options flow.
Let's look closely at Wednesday and Thursday's single stock and ETF positioning. Let's start with the panic. When the smart money decided they needed to hedge against this macro storm, where were they hiding? Or rather, where were they building their bunkers?
The institutional hedgers were aggressively targeting the most vulnerable sectors of the economy. SpotGamma pointed out massive, highly concentrated bearish flow in the Russell 2000, the small caps ticker IWM, and in corporate credit, specifically high-yield debt, HYG, and investment-grade corporate bonds, LQD.
The AM notes detailed some eye-watering sizes in these names. We are talking about 24,000 lots of IWM March 240 puts. We saw 50,000 lots of HYG 74788 put spreads, and an absolutely massive 77,000 lots of LQD March 108 puts.
To put that in perspective, those are massive institutional sizes. That is not retail speculation on Robinhood. That is coordinated massive risk-off positioning by major funds.
I want to pose a fundamental question here, though. Let's think critically about this. If the broader market is just trading oil headlines, if the whole narrative driving the fear is just about Iran and whether the Strait of Hormuz stays open, why are corporate credit and small-cap domestic equities taking the absolute brunt of the institutional hedging?
It's a great question.
Right. If I'm worried about a war in the Middle East, why don't I just short the S&P 500 directly?
Well, that is the exact question a good analyst should ask, and it raises an important point about second-order effects in macroeconomics. The experts at SpotGamma essentially extrapolate that an oil shock isn't just an energy story, it's a massive inflation story.
Right. Energy is the base input cost for everything.
Exactly. If the conflict escalates and oil stays elevated at $100 or $120 a barrel, inflation reaccelerates globally. If inflation reaccelerates, the Federal Reserve is completely trapped.
They can't cut.
No, they cannot cut interest rates to support the economy, and they might even be forced to hold rates higher for significantly longer than anyone anticipated.
I see the connection. And who suffers the absolute most in a higher-for-longer interest rate environment?
Small-cap companies and the corporate credit market. Large-cap tech companies in the S&P 500 often have massive cash reserves and locked-in long-term debt.
Right. They don't care about short-term rates as much.
But small-cap companies in the Russell 2000 usually rely on floating-rate debt. They require constant refinancing just to survive. Corporate credit ETFs like HYG and LQD are highly sensitive to any increase in borrowing costs or default risk.
So the institutional smart money wasn't just blindly hedging against an oil spike. They were playing chess. They were hedging against a lingering global credit crunch and an inflation shock driven by that oil spike. They attacked the absolute weakest links in the economic chain.
Which is the hallmark of sophisticated capital preservation. You don't short the strong, you short the fragile.
Which makes perfect sense when you map out the plumbing. But in the middle of all this credit panic, there was a glaring, almost absurd exception that stood out in the options flow.
Oh, the AI tech names.
Yes. While the credit markets were screaming recession and higher for longer, the technology sector was screaming new paradigm.
We are talking about the AI divergence. It was one of the most remarkable structural disconnects of the entire week.
On Wednesday, while the rest of the market was sweating the inflation data and the oil prices, Oracle reported earnings. And instead of getting dragged down by the macro correlation, Oracle jumped 8%. The source notes explicitly highlight that it held its 140 put wall perfectly.
Let's clarify what holding a put wall means in this context.
Yeah, please.
A put wall is the strike price with the largest concentration of open put options. For Oracle, that massive concentration was at 140. When a stock holds its put wall, it means the dealer positioning is so heavy there that any attempt to sell the stock below that level is instantly absorbed by dealer hedging, which bounces the stock back up. It acts as ultimate support.
So Oracle bounces off its 140 put wall, ignores the macro panic, and just drives straight toward 170. And then you have NVIDIA. The notes highlight an incredibly aggressive trade. 14,000 contracts of January 2027, 195 calls were bought.
That specific size is highly notable because it was larger than the existing open interest for that specific strike at the time.
Meaning this wasn't someone closing an old position. This was someone opening a brand new, massive bet.
Correct. Someone was establishing a massive new long-term bullish position right in the middle of a geopolitical crisis. They were looking past the oil shock and clearly positioning ahead of NVIDIA's massive GTC conference the following week, betting that the artificial intelligence narrative would override any macro weakness.
I look at this market dynamic like a massive two-lane highway. You have the tech sector, specifically AI-adjacent tech like NVIDIA and Oracle, just cruising in the fast lane, completely fueled by internal catalysts, structural put walls, and massive capital expenditure.
Yeah.
And then in the slow lane, you have corporate credit, small caps, and traditional equities, completely stuck in traffic behind a massive, slow-moving oil tanker.
And unfortunately for the market, on Thursday, that metaphorical oil tanker became very literal. The macro reality finally caught up with the structural pinning.
Thursday was brutal. Real-world events finally shattered that midweek Honda-induced calm. Oil tankers actually came under physical attack in the Middle East. The theoretical risk became a kinetic reality.
So it was no longer just an implied fear.
Exactly. WTI crude shot up nearly 10% in a single day, hitting $96.22. The S&P 500 tumbled violently, closing at 6,673. And crucially, it broke decisively below the massive 6,700 put wall that SpotGamma had been tracking.
Breaking a major put wall is a highly significant structural event.
Walk the listener through the mechanics of put wall breaking. What happens to the dealers when support fails?
As long as the market stays above the put wall, dealers are generally in a manageable position. But when the market breaks below the largest concentration of puts, the dealers are suddenly plunged into deep negative gamma territory. All of those puts they sold are now in the money, and their delta exposure becomes severely unbalanced.
Which means they're forced to aggressively short the market to hedge themselves.
Yes. Breaking a put wall flips the dealer positioning from supportive to destructive. It exposes the market to heavier, accelerating negative gamma selling. And as expected, when that happens, the volatility metrics reacted violently. The VIX spiked over 12% on Thursday to close at 27.28.
And the notes point out that finishing at 27.28 meant the VIX closed above its own call wall of 25.
Which indicates the potential for a gamma squeeze higher in volatility itself. If the VIX breaks its call wall, the dealers who sold those VIX calls are forced to buy more VIX futures to hedge, driving fear even higher in a self-fulfilling loop.
So we roll into Friday morning, the market is bruised, the 6,700 put wall is broken, the VIX is elevated above its call wall, and naturally, financial social media FinTwit, or X, starts losing its collective mind. And this leads us to the viral volatility myth that SpotGamma had to meticulously dismantle on Friday morning.
This was perhaps the most brilliant piece of educational analysis in the entire week's notes. It perfectly highlights the danger of misinterpreting complex options data and feeding it into a panic narrative.
Walk us through it. What was the viral narrative that was spreading on Friday morning?
A viral chart was circulating widely on social media showing a metric called call-put skew, sitting at extreme historical lows. We are talking about levels rarely seen outside of major generational crises like the 2008 financial collapse or the 2020 COVID crash.
Okay.
The author of the viral tweet claimed, and I quote, "The cost of protection is near the most expensive levels in history."
If you are a retail trader sitting at home reading that on Friday morning, and you see a chart comparing today to 2008, you think the entire financial system is about to collapse. You are going to liquidate your portfolio.
Which is exactly why SpotGamma felt compelled to address it. They methodically tore this narrative apart. They pointed out that the author of the tweet fundamentally confused skewness with absolute cost. They are two completely different mathematical concepts.
Okay, let's break down the math for the listener, because this right here is the difference between blindly reading a scary chart and actually understanding how a market prices risk.
Let's start with skewness. The viral chart was measuring a concept known as risk reversal. The formula for risk reversal is essentially subtracting put implied volatility from call implied volatility.
Keep going.
SpotGamma looked at the actual data and showed that call skew was sitting in the 4th percentile. This means absolutely no one in the market wanted to buy call options. There was zero demand for upside speculation. Calls were being heavily offered by sellers, which drove their implied volatility down into the basement.
Nobody wants upside. Got it. So the call side of the equation is a tiny number.
Meanwhile, put skew was sitting at the 95th percentile. Everyone was desperately bidding up puts to protect against the weekend risk, driving the put implied volatility sky high. So mathematically, when you subtract a huge, massive put IV number from a tiny, microscopic call IV number, you get a massively negative result. The relative skew was indeed at historical extremes.
Because puts were infinitely more desirable than calls at that specific moment in time.
Correct. The market was completely heavily weighted to one side. But, and this is the crucial narrative-busting distinction, the absolute cost of those puts was not historically expensive at all. SpotGamma pointed out that the one-month implied volatility for the S&P 500 as a whole was only sitting at 19.5%.
Okay, pause right here. What does an implied volatility of 19.5% actually mean for the listener staring at their screens? If skew is historic, but Garvey is only 19.5%, what is the actual physical risk being priced into the market by the dealers? The notes mention something called the Rule of 16 to explain this.
The Rule of 16 is a foundational mental math shortcut used by options traders to convert annualized implied volatility into a daily expected move.
I've heard this tossed around trading floors, but let's break it down mechanically. What is the actual math here?
Implied volatility, like the 19.5% figure, is an annualized number. It represents the expected standard deviation over an entire year. But traders need to know what the market is expected to do today. To find the daily expected move, you divide the annualized volatility by the square root of the number of trading days in a year.
There are roughly 252 to 256 trading days in a year.
And the square root of 256 is perfectly 16. So you simply take the annualized IV and divide it by 16.
Let's do the math live. We take the 19.5% implied volatility from Friday morning and we divide it by 16. That gives us roughly 1.2%.
Which means the options market was only pricing in a daily move for the S&P 500 of about 1.2% in either direction.
Oh, wait, 1.2%? That's it? That is the so-called most expensive protection in history.
That is the reality of the math. Now, yes, to be fair, the spread between implied volatility, which was 19.5%, and realized volatility, which was still hovering around 11%, was high. It was an 8-point spread, meaning people were still paying a measurable premium for that insurance. But an implied daily move of 1.2% is absolutely, unequivocally not the most expensive protection in history.
Not even close. If we look back at actual historical crises like 2008 or the 2020 COVID crash, what was the daily move being priced in?
During true systemic liquidity crises, implied volatility routinely spikes to 50, 60, or even 80%. Using our Rule of 16, an IV of 80% means the market is pricing in daily, terrifying moves of 4% or 5% every single day. That is what historically expensive protection looks like.
So the viral tweet was basically sensationalism born out of bad math. It confused relative demand with absolute panic. It just meant puts were much more expensive relative to calls right now because no one wanted calls. It did not mean the options market was pricing in the end of the world.
It demonstrated an extreme directional bias, an extreme demand for puts over calls, but it did not demonstrate an extreme absolute panic. And understanding that mechanical difference is exactly what separates professional institutional analysis from social media noise. If you traded based on the viral tweet, you probably shorted the hole right at the bottom.
And as Friday dragged on, that mechanical reality played out. The market didn't crash. It was messy, yes, but it didn't collapse. It closed Friday at 6,632. It was pressured late in the afternoon by aggressive zero DTE call, selling the higher road delta, plunged to a negative $5 billion as traders sold calls to harvest premium before the weekend. That late flow proved that negative gamma and volatility sellers were still firmly in the driver's seat heading into the weekend.
They were actively pinning the market down, compressing the volatility, but they absolutely weren't letting it collapse into a free fall. It was a heavily managed, structurally dictated decline, driven almost entirely by options positioning rather than pure, unadulterated fundamental panic.
Which brings us to our final summary for all our TSS traders listening today. This entire week, from March 9th to the 13th, was an absolute masterclass in how massive macro shocks, like an escalating Iran conflict, soaring inflation fears, and oil surging toward $120, don't just hit the market cleanly. They don't just cause a straight line down. They get filtered. They get digested, twisted, and managed through the mechanical plumbing of the options markets.
The headlines provide the catalyst, they provide the spark. But the structural plumbing dictates the actual destination of the price action.
We saw a gamma trough systematically exacerbate intraday swings because dealers were forced to buy high and sell low. We saw 0DTE iron condors artificially compress volatility on Wednesday, acting as synthetic shock absorbers. We saw the Hugh Hendry trade squeeze the market upward on Monday simply because institutions were monetizing historical put skew. And underneath it all, we saw that massive JP Morgan 6,475 put wall acting as a gravitational floor, a mathematical trampoline keeping the whole system from falling into the abyss.
It highlights how critical it is for any serious trader to look beyond the spot price and the news ticker. You have to look at the higher delta flows, you have to understand the VIX divergence, and you have to know the difference between absolute and relative volatility premiums to actually understand what the smart money is doing with their capital.
And that leads me to a final thought I want to leave you, the listener, with today. A provocative thought to mull over and explore as you map out your risk for your next trading session. Throughout this incredibly stressful geopolitical week, systematic 0DTE flows and massive institutional iron condors acted as intraday shock absorbers. They constantly reverted the market to the mean, fighting off historic headline tension. They kept the system glued together. But what happens when the macroeconomic environment shifts? What happens if that massive volatility premium finally contracts? If the VIX drops, and those daily structural stabilizers, the condors, the systematic put selling simply vanish because the premium isn't fat enough to justify the risk anymore? If then, right after the structural protection evaporates, a major unexpected macro shock hits, will the market lose its mechanical shock absorbers right at the exact moment it needs them most?
The implication is terrifying. It's asking what happens if the structural X-ray machine suddenly powers down just as the patient goes into actual cardiac arrest. If the dealers aren't incentivized to provide that pinning liquidity, a 5% drop could easily become a 10% freefall.
Will we be left trading in the dark without a safety net? It's something you must consider as you build out your risk models moving forward. We want to thank you for joining this deep dive into the source material. We hope you feel a little more equipped to read the X-ray. Stay sharp out there.